So yeah, I think let's start now. So hi everyone. So we will
Hi,
be
Ami.
yes. Should I start
Ami,
then?
I just want to introduce you before starting this webinar
Yes. Okay.
to our
Okay.
participants.
Okay.
So, hello everyone. Good evening from Educating. Today we have CA Ami Dhabalia with us, who has diverse experience in the field of finance. She has started her career as a taxation tutor with the best of institution in Mumbai, to having managed the entire finance function for a Times Group subsidiary and lead their GST and IFSC implementation. She has rich knowledge in direct and indirect taxation, internal controls, and implementation. She possesses strong business acumen, sound technical knowledge, and leadership talents. She has not only successfully headed advisory assignments across business sectors, but has also won accolades from all the clients for improving their data flow. So currently she is partnered with Mahesh Dhabalia and Company, a Mumbai-based CA firm, which is 35 years old. Over to you, Ami. Today she is going to have a webinar on the topic of residential status and taxation of transaction of properties. Over to you, Ami.
Yeah. Thank you, Pooja, for your kind words. So hi. So just to clarify, so we'll be discussing the determining your residential status, that your residency test, as well as certain rules in terms of sale or purchase of property in India by foreign, foreign residents or non-resident Indians. So let's start with determining the residential status. So because this webinar is for an hour, and the topic is really wide, there are certain terminology which, I have just explained in very short. So just clarifying that. Also, question and answers will be directly, either we'll take at the end of the session or on YouTube directly. So in India, residential status is determined on the basis of the number of days of stay in India. And the reason this is so important is that directly the taxation rules, the applicability of the taxation rules in India directly depends upon the residential status. So if you see the third point, taxation of individual is primarily based on their residential status in the relevant tax year. Also, residential status is to be determined each year. Okay, so you can be a resident this year, you can be a non-resident the other year, and vice versa. Now, what is the residency test? Now, in India, for the purpose of income tax law, individuals can be clarified or classified into three residential status. One is the ROR, that is a resident and ordinarily resident in India. Second is resident but not ordinarily resident in India, that is RNOR, and non-resident, that is NR. Residential status of an assessee must be ascertained with reference to each previous year, that is a financial year. A person who is a ROR in 1 year may become a non-resident or RNOR in another year, and vice versa. So we will little to the sections, because after the amendment in the last financial year 21, 22 and 2021, this is a little bit more important. So there are 2 steps. So first step, that is what we are going to discuss right now. Step 1 is determining whether a person or an individual is a resident or a non-resident. Now, once you determine that the person is a non-resident, the story is over. Non-resident means non-resident. But if the person is a resident, then we further determine whether the person is a ROR or a RNOR. Okay. So, and ultimately, the taxation differs on 3 bases: when you are a non-resident, when you are a ROR and when you are a RNOR. So right now we are going to determine whether the person is a resident or a non-resident as per step 1. So under section 6.1, please take note of section 6.1. An individual is said to be resident in India in any previous year, that is a current, that is the financial year in question, if he satisfies any of the following conditions. He has been in India, that is, he has stayed in India during the previous year for a total period of 182 days or more, or he has been in India during the 4 immediately preceding previous years. That is, if my financial year in question is 20 to 23, then my 4 years will start from 21-22, 20-21, 19-20, and 18-19. So he has been his stay in India in the 4 PPY, that is the preceding previous years, for a total period of 365 days or more, and has been in India for at least 60 days in the relevant previous year. So for this second condition, you have to consider 5 years. The first year is the year in question, and the 4 years are the 4 years for preceding previous year in which the stay has to be at least 365 days. Now, if the person satisfies any one of these 2 conditions, then he is a resident. If not, then he is a non-resident. So if the individual satisfies any one of the conditions mentioned above, he is a resident. If both are not satisfied, then he is a non-resident. Now, exceptions to point 2. Point 2 is this point of, point 2 is this point, number 2, of 60 days or 365 in 4 years. Now, let's check what the exceptions are. Now, the following categories of individuals will be treated as resident in India only if the period of their stay during the relevant previous year amounts to 182 days or more. Now, what they are saying is that the condition number 2, that is this 60 days, 65 days in 4 PPYs. What they mean is that this 60 days will be replaced by 182 days. All right. So who are these people? So the following categories of individuals will be treated as resident in India only if the period of their stay during the previous year amounts to 182 days or more. In other words, even if such persons were in India for 60 days or more, but less than 182 days, they will not be treated as resident due to the reason that their stay in India was for 365 days or more during the 4 PPYs. So basically, their stay for 365 days or more in the last 4 years does not matter. Okay. So who are these individuals? First is Indian citizen. Now, please note, this is just Indian citizen and not PIO. Indian citizen who leaves India as a member of a crew of an Indian ship or for purpose of an employment outside India. Now, these are the Indian citizens who are going out of India. And so basically, if you are an Indian citizen and you are working as a crew, member of the crew of an Indian ship, and you leave India, then if you have stayed in India for less than 182 days, then you are straight away a non-resident. All right. If your stay in India is for more than 182 days, then you are a resident. The second exception is Indian citizen or person of Indian origin. Now, who is a person of Indian origin? The person in question or their parents or the grandparents were born in undivided India, that is on or before 15th August 1947. Who, being outside India, comes on a visit to India during the relevant previous year. However, so these are the people who are coming in India. All right. However, such persons having a total income other than foreign income exceeding 15 lakhs will be treated as resident if. Now, if you see these 2 conditions, basically These 60 days are now replaced by 120 days. All right. So if you, again, we will just revise this point. If you are an Indian citizen going for an employment or as a crew of an Indian ship, then your citizenship will be, your residential status will be determined by your number of stay in India, that is 182 days. If less than 182 days, non-resident. If more than 182 days, resident. If you are an Indian citizen or a PIO, and who has come to India for a visit, but total income is less than 15 lakhs. Now, this total income goes without saying that it is only Indian income. All right. If it is less than 15 lakh, then again it is 182 days. But if it is more than 15 lakhs, then the 60 days will be replaced by 120 days. So if you are an Indian citizen, let's say you live in Australia and you come to India, and your obviously your income, Indian income, is more than 15 lakhs, then for the condition, suppose you stay in India for 150 days, then in that case you are a resident. But if you stay in India for 100 days, then you're a non-resident. Okay. So these are the two exceptions. Now, keeping this in mind, there is another provision, that is section 61A. This is deemed a resident. Now, there are many people who do a lot of dynamic entrepreneurs, dynamic business men, and business people who basically travel a lot, and because of the different provisions. So, for example, in India, residential status is determined by number of stay in India. It's similarly in most of the countries, the residential status is determined by the stay in that country. So it happens that a certain person is earning income in multiple countries, but at the end of the financial year, that person is not a resident of either of the countries. So what happens is, because of the tax laws, the income that person is earning is not taxed anywhere. So this is a loophole, and which let's read this, how we have got that. An individual being an Indian citizen have total income other than foreign income exceeding 15 lakh during the previous year would be deemed to be a resident in India in that year if he is not liable to tax in any other country or territory by reason of his domicile or residence or any criteria of a similar nature. So let's say an Indian citizen hai, and their total income from Indian sources is more than 15 lakhs, and he is not a resident in India. Okay, but his income is not liable to tax in any of the countries, then he will automatically be deemed to be a resident in India. Now read the note. However, this provision will not apply in case of an individual who is a resident of India in the previous year as per section 6(1). So that is what we just read. If he is a resident as per the rules which we read, then deemed resident does not come into play. Okay. Yeah. So liable to tax, this is a very short meaning. It's basically relation to person and with reference to a country, means that there is an income tax liability on such person under the law of that country for the time being in force. It also includes a person who has subsequently been exempted from such liability under the law of that country. So even if you are exempt, the liable to tax will still be applicable to you. Okay, so once, as I said earlier, once it is determined that you are a resident, we will now see whether you are a ROR or RNO. All right, but before coming to this point, let's discuss an example so that the first step is a little, it's clearer. So first example is Mr. D, whose head is the business head and for a private firm. He was born and brought up in India. He has to travel to various locations of the continent for business purpose. He has spent 200 days traveling in the current financial year. It means that he was in India for 165 days. Also, he has been traveling abroad for the past 2 years and has stayed out of India for about 400 days in this period. Let us evaluate whether Mr. D was resident in India for the current financial year. So condition 1. So what was condition 1? Residing in India for at least 182 days or residing in India for 60 days and 365 days in the 4 PPYs. So condition 1 of 182 days is not fulfilled. Why? Residential status, you will understand that he has only spent 165 days in India during the current financial year. Hence, he does not satisfy the first condition. Let's see if he satisfied the second one. Condition 2, he resides in India for a minimum of 365 days in the immediately preceding 4 years and for a minimum of 60 days in the current financial year. Now, this condition is satisfied. How? However, it is given that Mr. D has been traveling only from the past 2 years. Also, it is said that he has traveled for 400 days in the past 2 years. Means in the past 4 years, out of 365 into 4, less 400, he was in India for 1061 days. Hence, he has resided for at least 60 days in the current financial year and for more than 365 days in the immediately preceding 4 years. Now, therefore, he satisfies the second condition and he is a resident. So I hope that, this point is clear with this example. So once you determine that person is a resident, we will now determine the person's status as a ROR or a RNOR. Now, if only individuals in HF can be resident, but not ordinary resident, RNOR in India. All other classes can either be a resident or a non-resident. A not RNOR is the one who satisfies any of the conditions. Now, this is section 6.6. First is if such individual has been a non-resident in India in any 9 out of 10 PPYs, or you can read this as if an individual has been a resident in at least 2 out of 10 PPYs, or if an individual has, during the 7 PPYs, been in India for a period of 729 days or less. How you can read this is the first condition, and such an individual has stayed in India for 730 days or more in the last 7 PPYs. So if a person is a resident, then you come to the second condition, step 2. And these are the additional conditions. If both these conditions are fulfilled, then the person is a ROR, otherwise he is a RNOR. So first condition is resident in 2 out of 10 PPYs. Now these at least two or more out of 10 PPYs, you have to practice the step 1 again for each of the years. All right. Excuse me. Yeah. If such an individual has, during the 7 years, that person is staying in India for 730 days or more in the last 7 PPYs. If such individual, now the third condition, read this a little different from the first 2, but this is again a very important amendment. Okay, fine. If such individual is an Indian citizen or a PIO, who being outside India comes to visit, having total income exceeding 15 lakh other than foreign sources, and who has been in India for between 120 and 182 days. Now again, this is the exception number 2 to point 2 of step 1. If a person is an Indian citizen or a PIO and their Indian income is more than 15 lakhs, then the 60 days replaced by 60 days are replaced by 120 days. And if that person has stayed for, let's say, 150 days, then that person is a resident, but automatically that person becomes a RNOR. And the last point is the deemed income. Any resident, any person who is a resident by virtue of section 6(1)(a), that is deemed resident, deemed to be resident, is automatically a RNOR. So these are the points which are to be remembered for step 2. Now let's do an example so that we understand better. So yeah, this is done. Yeah. Yeah. So the conclusion to example 1 was, yeah, this is done. Okay. There is a further classification under RNOR and ROR. Again, we're just reiterating this. In addition to the basic condition, if both the below are met, he will be a ROR. He has resided in India for at least 2 out of 10 previous years, and he has resided in India for at least 730 days in 7 immediately previous years. In above example, Mr. D has satisfied as a resident in India. Let us further classify whether he is a ROR or RNOR. If both the additional conditions are satisfied, then Mr. D is a ROR. Considering the example, he was traveling out of India since past 2 years only. Before that, he was in India. So obviously, he's a resident in at least 2 out of 10, because every year his stay in India is more than 182 days, right? Hence, the first condition is satisfied as he resided in India for at least 2 out of immediately 10 previous years. Also, he has fulfilled the criteria of residing for at least 730 days in the last 7 years. Therefore, he can be considered as ROR. So let's do one more example. And yeah, so things will be a little, it will be better to understand. So Brett Lee, an Australian cricket player, visits India for 100 days in every financial year. This has been his practice for the past 10 financial years. Find out the first, we are just going to do the first point right now. Find out his residential status for the assessment year 23-24. So determination of residential status. Now, he has been in India for 100 days every year, right? Last 10 years then. So he is also he's not an Indian citizen. So those exemptions we don't have to think about. So the first condition is 182 days. He does not fulfill it. But the second condition of 60 days and 365 days in 4 PPYs, period of stay is 100 days. So calculation of period of stay during 4 preceding years is 400 days, right? And then in 60 days. So obviously he satisfies the second condition and he's a resident. So Mr. Bretley has been in India for a period of 60 days during the previous year and a period of more than 365 days in the 4 PPYs. Therefore, since he satisfies one of the basic condition under section 6(1), he is a resident. Now let's calculate whether he is a ROR or a RNOR. So computation of period of stay for the 7 years is 700 days. Since his period of stay in India during the last 7 years is less than 730 days, he is a RNOR. So therefore, he is a resident, but a not ordinary resident during the previous year. So also, we need to calculate whether he is a resident in at least 2 out of the 10 PPYs. All right. Yeah. So this is again the same condition which we are reiterating. All right. And because it is only 700 days and not 730 days, we are not really calculating the resident in 2 out of 10 PPYs. So automatically becomes a RNOR. Now, let's go back to the main question and see point number B. Would your answer change if the above facts relate to Srinath, an Indian citizen who resides in Australia? I'm sorry, who resides in Australia and represents the Australian cricket team. So please note, Srinath is an Indian citizen. Okay. And now he's coming to India and similarly staying in India for 100 days. So now what will happen? If the above fact relates to Mr. Srinath, an Indian citizen who is residing in Australia, coming to visit in India. So remember, it's the exception number 2. He would be treated, sorry, exception number 1. He would be treated as a non-resident in India, irrespective of his total income. That is, total income can be more than 15 lakhs or less than 15 lakh, does not matter. Why? Because the stay in India is less than 120 days. So actual condition applicable to Srinath is 182 days. That is the first exception. But we don't really have to think about the income being less or more than 15 lakhs because the stay is just 100 days. So, oh, sorry. Yeah. So in that case, he would be treated as a non-resident. Again, let's go back to the question. The third point is, what would be your answer if Srinath has visited India for 120 days instead of 100? So again, he is an Indian citizen. And in this case, his income is more than 15 lakhs. Okay. So Srinath's total income, other than foreign sources, is more than 15 lakhs. He will be treated as RNOR. If you remember, we had done the second condition. All right. Since his stay in India is 120 days in previous year 20 to 23 and 480 days in immediately 4 previous years. All right. So if you see the exception 2, person should be an Indian citizen or a PIO. Income should be more than 15 lakhs and stay should be more than 120 days in the previous year or 365 days or more in the 4 PPYs. Now he satisfies both the conditions. So he is a resident. But as per the exceptions or as per the rules of the additional conditions that is determining ROR or RNOR, such an Indian citizen or a PIO whose income is more than 15 lakhs and who has stayed between 120 to 182 days will automatically become a RNOR. So that's why in point number C, Srinath becomes a RNOR. Now see the last paragraph. If his total income other than foreign sources does not exceed 15 lakhs, then we will have to again check the condition of 182 days and not 120 days. And then he will be treated as a non-resident because it is obviously less than 182 days. He is just here for 120 days. So I hope this, I'm sorry, this is clear. This is a diagrammatically, it's a representation of what we just did, but I think the theory is much more simpler. Yes. So this is, part 1. Let's now just get on to the sale and purchase of property. Yeah, I think, yeah, we'll take questions in the last 10 minutes because, okay. So sale and purchase of property in India by NRI or foreign citizen. Now, this topic is very, very wide and a little complicated. I would like to, clarify here that majority of all these transactions, FEMA rules are applicable. In income tax, mainly the TDS compliance is to be seen. But when you are selling or purchasing an immovable property and you have a status of an NRI or a foreign citizen, these rules are to be kept in mind. So first part is acquiring of immovable property in India. So these are the general prohibitions under FEMA in relation to acquiring of immovable property in India. All non-residents or foreign citizens are not allowed to deal in immovable property, which is agricultural land, plantation, property, and farmhouse. So absolutely not allowed. Foreign citizens who are not NRI and PIO are not allowed to deal in any immovable property in India. So you can be, let's say, a German origin person living in India, but you don't have an Indian passport. Then you cannot deal in any immovable property in India. If you have an Indian passport, obviously now that entire concept will depend upon the passport rules. When a foreign national can get an Indian passport. So all these things have to be checked. But let's say a German origin person, German national is living in India and holding an Indian passport. In that case, he is an Indian citizen. He will be able to deal in immovable property in India. So all these points need to be considered. Citizens of all these countries, irrespective of whether they are citizen, non-citizen, residents, whatever the status, they cannot purchase or sell property in India. Who can purchase immovable property in India? Under general permission available, following categories can freely purchase the immovable property in India. One is the non-resident Indian, and second is person of Indian origin. Indian origin, again, person whose parents or grandparents were born in undivided India. Also, here the definitions of not income tax but FEMA has to be considered. So FEMA definitions are a little different. So if you're checking out, then please check the FEMA definitions. Foreign national of non-origin residing in India can purchase immovable properties subject to specific approval of RBI in consultation with Indian government. So a foreign national of non-Indian origin. So a foreign national who is not of an Indian origin, okay, but can be a NRI. So they can purchase the immovable property, but again, they have to, get specific approvals. Who can receive immovable property as gifts in India? NRIs and PIOs can freely acquire immovable property by way of gifts. From whom? From a person resident in India, from an NRI or a PIO. Again, foreign national of non-Indian origin resident outside India cannot receive any immovable property in India through a gift. So let's say a person, let's say a Britisher, is an NRI. Now, his son may not be. His son may be a foreign national of non-Indian origin. So then that gifting is not possible. So such things are to be kept in mind. Who can receive immovable property as inheritance in India? Inheritance is basically, what you mention in the will, and you can inherit, not a gift, when the person dies and what is passed on to. So the NRI, PIO, and foreign nationals of non-Indian origin can inherit immovable property. So please mind, this is non-Indian origin. They can inherit immovable property from a person resident in India and a person resident outside India. However, the person from whom the property is inherited should have acquired the same in accordance with FEMA regulations or earlier laws applicable at the time of acquisition. Now, the FEMA regulation here is a little of a heavy concept. So basically, what money you can use to purchase the property and what should be the source of the money, and there are many other conditions, but they have to be adhered to. Only then the foreign nationals of non-Indian origin can inherit. The second part is transfer of immovable property in India. Transfer of property other than agricultural land, plantation property, and farmhouse. As we mentioned in the first part, these three properties are not freely transferable. NRI, PIO, foreign national can sell or give immovable property to a person resident in India, to a NRI, or to a PIO. Following transfer requires prior approval of the RBI, PIO to PIO transfer, and transfer by a foreign national. Last is who can transfer agricultural land, plantation property, and farmhouse. NRI, PIO, foreign national can sell or gift agricultural land, plantation property, and farmhouse in India only to a person resident in India. Now we can ask, how did a foreign national received received an agricultural land in the first place? So transfer by a foreign national will require prior approval of RBI. So you can see, yeah, you can see in the part about inheritance. So they can inherit immovable property. So that is how the agricultural land may have fallen in the lap of that foreign national, and then subsequently this is how the transaction can take place. So yeah, I think this is yeah. So we are done, and I think we can do a little question and answer if anyone wants to ask. Also, Pooja. Hi, Pooja. Okay. Anyways, I'm just mentioning my email ID here in case anyone wants to ask me any questions even later on. And I think Pooja will be sharing this PPT with you guys. I'll just share it with her. And yeah. Any questions, anyone? Yes, hi. Hi, Hemant. Yeah, Hemant, you can type your question. Hemant, you have raised your hand. You can, yeah. Okay. So day of departure and arrival with time factor. Yeah. So let's say you have left today at 11 p.m. Okay, रात को 11 बजे का flight है. Now only 1 hour is left, and in that case you can consider that 1 hour as a whole day. So let's say you are leaving on 11 p.m. on the 20th. So that 20th can be considered as one full day. So let's say you are out till 20 to 25 and you're coming back on 25th. So you will consider 20 and 25th both for, calculating the number of days. So 20, 21, 22, 23, 24, 25, that is 6 days. And Ceci went abroad on study visa for 5 years, rendered online tuition to Indian citizen. What will be residential status and how this tuition? So he went abroad on student visa. So he is not in India, right? So his residential status is that of a non-resident. So then this income will not be treated or taxed in India, Amit. Yeah. Thank you. Gift relative in India is taxable. NRI. If the relative if the relative is under the 22 relatives, which is mentioned in the Income Tax Act, then this will not be taxable, even if it's from an NRI to an Indian. The limit of 50,000 is applicable, I think. Yeah. Yeah, I think so. Okay, I can clarify. You can just email it to me. I'll give you an answer on email. To get FTC, only federal tax to be considered for USA. Hemant, I am not sure about this. You can email this to me, please. I'll answer this on email. Okay. So this, okay. Thank you, everyone. And all right, I'll sign off. Thank you.